God bless everybody. Today is August 21st of 2023. Markets are set to open approximately 2 hours, and we're going to watch potentially a lot going on this week, potentially even a Black Swan event. So we'll see how that turns out. Let's look at what's going on out here. I've got a number of charts. The bonds are melding up, and so we need to see how this is going to turn out and how that's going to affect us as we move forward. So you can see Bitcoin, it's been hit pretty hard just in the last few days. You can see through this chart, we've had a massive drop. It was over, a little over 30,000. Moving closer to 31,000, then it dumped, and now we are down around under 26,000. So we've seen about a 3,000 point dump on Bitcoin, and so I think we have potential some downward movement here. We'll see the dollar is dictating a lot of this, so as the dollar moves up, Bitcoin dumps. You'll see gold and metals also dump. Usually the dollar goes up, Bitcoin and metals tend to go down. So right now we see Bitcoin under 26,000, and we'll see how that turns out as we move forward. And on this chart you can see Bitcoin basically in the last month you've dumped about $4,000. So I always say in this case, now we're going to be talking about a fire sale here for long, so this might not be exactly how I go with this. And I do not want to give you any kind of financial advice here because I am not a financial guy, so just realize that. But anytime you get under 20,000, you can probably buy into Bitcoin, and even if it really goes down, it's going to come back up, and once this corrects itself, this probably will X up also over time. But you could have a fire sale like I've been talking, and this could dump under, potentially 20,000, 15,000. So just keep an eye on the markets as this goes on. This one's going to get real interesting as we move forward. So now I'm going to try to make this a fairly quick video because I just want to go over a few things just so you can be aware of what you should be looking at. This chart's really interesting because this is a 30-year fixed mortgage rate, and you can see we're starting to spike again. Now back in the 80s, and I remember some of this, people were paying 18% plus interest on their homes. We're now around 7 to 8% depending on where you go, and so especially regional banks will tend to be more, or local banks, but just realize that we're starting to see this pop up pretty strongly, and this is where if you're locked into a 30-year fixed loan, before these rates started to spike back here, you're not willing to sell your house at a rate here and then have to rebuy. So most of these people are entrenched. They're not going to get out of their homes. You're going to start to watch housing fall off here, and people aren't going to get loans at 8% interest rates as we move forward. The banks can't loan, and there is a reason for that, because the 2-year bond treasury rate is at about a 5%, and then when you get down into your 10s and 30s, they're over 4%. So there's a gap between, they're just losing money because they borrow at the 2-year rate, which is 5, and they're loaning at the 10-year rate, which is about 4.25. You get into a 30-year, that's actually even higher, as I'm going to show you. So Other things that you probably should be watching are the metals. If you have a little bit of extra liquid income, which I know a lot of you don't, and that's understandable. Most people don't own metals. Actually, only about 1% of the population own any kind of metals whatsoever. And so they're suppressing these prices now. Once they do actually start to X up, you could see maybe silver move up 2 or 3 times what it is now, because these prices are suppressed as the banks and governments are buying up these metals at this time so that they can bring in these digital currencies and back them with something. So just realize, you know, right now you're under $23. That's probably not a bad purchase on silver. You get into gold, that you know, most people can't afford that, but it is under 1900 right now, so that's something you could look at. So let's look at some of these treasury rates and why this is a real problem. So the banks borrow at the 2-year rate and then loan at a longer term rate, 7, 10, 15, 30 year, whatever it is they're loaning at. So you can see this is what we call a melt up. What do you mean by that is the bond rates are moving up, and so that's forcing all of your rates that you're paying on not only houses but cars, commercial properties, things like that. All these rates are moving up, and they're all moving up from the 2 through the 30. So you're not getting any breaks here, and the foreigners are getting hit more than we are here, because they have a tendency to be more predatory in their loans, and they have like 1s, 2s, 3s, 5s, and so these short-term duration loans tend to get expensive. But when you have a 2-year rate at 5, and this is what the banks borrow at when they're loaning at a 7, 10, or 15 or 30 year, and those rates are, let's say, at 4.25, which you're going to see here, the banks are losing money immediately on these loans, and so they can't loan. And when the 30 year gets to 8%, they're not going to loan, and so this is a real problem for the banks in general. The other problem that we're running into is the value of the house or the car or the commercial property is worth less than it was, let's say, a year ago. These prices are starting to fall, and you can go out. It's based on the region and the state and different things like that, but in general, overall throughout the country, you're watching these rates of these homes start to move down. You know, if you have, let's say, in a certain area, you've got a $600,000 house, that may have devaluated maybe 30%. And so the banks can't loan. And if you were locked into a 30-year rate at, you know, 3 or 5%, the last thing you're going to want to do is sell your house and move into another home with a much higher rate of maybe 2 to 3 times what you had originally. And these, you know, if you're talking about a home at 400,000, these rates can go up drastically. So I wanted to just throw this down on you guys so you can see the, you know, how this really affects you. Let's say if you got a, you know, $240,000 home loan, which it's ridiculous. You know, anytime, you know, the average median price of a home is $400,000 here. So just realize how stupid this is getting, and that most average people can't afford a home. And as this moves forward, that's going to become even harder. So just realize this is an absorbent amount of money they're asking people. And so just realize that you know, if you have let's say if we take the median home, that's how crazy this is. So let's look at this. So you got a mortgage loan $400,000 at almost 8%, you're paying almost $3,000 on that loan, on a 30-year fixed loan, okay? And you can see, you can go to all these different loans and different things and look how they can adjust. And yes, the rates are a little lower, but these rates are much higher than they were, let's say, when you were paying 5.5. See how much that changes? You go to 8%. Look at the difference in the rates and how this has changed. Let's say if you go, with a large bank that was loaning 3.5, these rates matter, especially in these 7 years, because these are going to revolve and you're going to get hit. Let's say you were at a 3.5% rate and then you're redoing your loan, because it's been, you're at your 7 years, and now they want to charge you, let's say, 7.8%. You see the difference in the cost of how much that's going to run you. And so these rates that are melting up when you get to especially a 30-year fixed, and you go to, let's say, with an 8%, as they indicated pretty much, that you're going to get really hammered on these loans. Now a 30-year fix, you're locked in, so you don't have to think too hard about it. Let's say if you were at 3.5, at 1796, and now you're moving up to this 8% rate, most people can't afford an extra $1,200 for the same house. And this house is undervalued now. It may not be worth what you paid for it. You purchase this thing, it's sort of like a car. You drive it off the lot and it's just not worth as much. So just realize that, when you get into these loans, different loans, most of these regional banks, especially in my area at least, move us to these 7-year, what I call a predatory loan. The reason I say that is they're for bad credit, usually, people, but they've lumped everybody into the same loans. And it doesn't matter what your credit score is, but yet the bank can give you a better rate based on your credit score. So they're picking and choosing who gets the better rates, and then they're revolving these rates. And so if you've got a 30-year plan, let's say normally a 30-year fixed rate, and they've locked you into a 7-year loan or a 6-year loan, then they're revolving this potentially 4 or 5 times on you. And so these rates could potentially, and back in the 80s, we saw that. Okay, so this is how stupid this could get. 18% rate on a $400,000 house is incredibly insane. And if you went from 8% to 18%, how that really changes your payment structures. Most people are going to hand the keys in, or they can't afford these kind of prices. So just realize that there is a huge difference as these bonds melt up. These rates go up as we move forward. And we'll go back to the original setting. You can see that a $240,000 house today, 30-year fixed loan, is at 8.001%. You're going to pay about $1,761, and that's not including your property taxes, insurance, and all the other things. And if you move down into a 7-year ARM or 6-year ARM, you're paying about $7.665 at $1,705. And like I said, if back, just in the recent past, a lot of these banks are charging 3.5 or 5.5 on these loan structures. And so you can see how, when you adjust these numbers, how that's going to affect you. And so that was one of the reasons I always question the regional banks. When I can go into, at least a couple years ago, I'd go in and get a 3.5% loan why I would come into a regional bank and they charge me $300 a month more, or basically a 30-year durational loan. I'm not seeing the benefit of that, but that's just me. So right now you got a 2-year treasury bond. That's what the banks are borrowing at. They're borrowing at almost 5% at 4.964. If you go to a 10-year, you can see that's adjusted up to 4.296, and so these are melding up. All these rates are slowly moving up, and this is forcing everybody to pay more. And this 10-year is the one that one of the ones that you really should watch, because this really dictates the 7 and 6 ARM loans out there, and anything below that, because like I say, the banks are borrowing at the 2, loaning at the 7 or 10, 15 or 30. And then you get into this 30-year rate, you can see this has really moved up. And this is the one that really is troubling everybody on the long end here, because this is extremely high, and you can see this is spiking, and it just keeps moving up and melding up. And so this is a problem for everybody, especially the banks. And the other thing about the banks is they've just put in new regulations where they've required them to hold 2% more money, and the banks don't have any money in their actual vaults. They loan all that money to the Fed to make money, and since they can't loan money due to the inversion, this is a problem for them. And so we're going to start to watch massive layoffs of loan officers and people within the banks due to margin compression and things like that. So this one man is a lot of the majority of the reason the global markets are melting down right now, because he keeps continuing to raise these rates, and the foreign markets are screaming right now because he won't stop. Now, we just had this meeting on Wednesday of last week on the 16th, and I said this was going to be a bad time, because even though he didn't raise rates, he indicated he was going to be hawkish and he's going to move these rates up. So this man now is in Jackson Hole. They're going to talk about what to expect next, how they're going to keep raising rates, how they aren't getting their mandates of unemployment or getting inflation under control, and so how he's going to keep moving these rates up. And so you're probably going to see a rate hike in September, and the markets are starting to react to this, and that's why you're starting to see the markets get hit here in the last few days, especially from Wednesday forward as we move forward here. So, and the markets have been sort of tanking the last 3 weeks, as you can see through this bulletin. There's a lot of reports coming up this week that's really going to affect us and how the markets move forward through this week. You got existing home sales, which are probably going to be down. You can see the previous numbers. They aren't giving any forecasts because the numbers are data driven, they keep telling us. You got the PMI numbers and new home sales on Wednesday. And like I said, existing home sales were on Tuesday. You've got the PMI and the new home sales on Wednesday. You've got the you got meetings in Jackson Hole, and they're going to be talking about this, and so the markets are going to react to what's going on in Jackson Hole as they're getting initial jobless claim numbers and durable good orders, which is going to show margin compression and how the manufacturers doing with these PMI numbers, and also Powell's going to give an opening speech on Friday with the University of Michigan consumer sentiment numbers on Friday, and so there is a lot happening as we move forward in this week. So realize that the markets could be extremely turbulent as we move forward here. And just for your own information, I wanted to let you know what the PMI is. That's the Purchasing Manufacturer or Managers Index, and this is a survey-based indicator where they go out to businesses and look at their conditions, which include individual measurements, of business output, new orders, employment costs, selling prices, exports, purchase activity, supplier performance, backlogs of orders, of inventories of both input and finished goods, and they basically go out and see the how these companies are doing, and whether they're holding up under these stresses. A lot of the companies aren't getting loans at this moment in time because the banks aren't willing to loan, and so you're going to watch a lot of defaults because not only can they not make the payments on a lot of these commercial properties and different things like that, the banks aren't willing to loan to them, and so companies are just going out of business due to this. Now, this 210 inversion spread is not as extreme, but all the bonds have melted up from the 2 through the 30, and so even though this gap is not as extreme or close to that 100 point gap, the 2 is moving up to the 5, and the 30 is moving up much stronger, and so regardless of whether the gap isn't as much, all the bonds are moving up, and so it's affecting us on every level. And so regardless, this could gap out more, and what Jay's looking at on that 2-year bond is potentially a 6% 2-year, and that's why he keeps talking 6%, that he wants to potentially move this up another half point from 5.5 to 6, because the potential bond meld up of the 2 is here, and could move up to where we could get into a bond rate of the 2 maybe at 6%, and that would then drive all the long end rates up also, and then you're starting to move back into those 1980s where you're starting to see 10 to 18% rates again on homes, and that's absorbent for most people. They aren't going to be able to afford this, as they've been squeezed by all these other costs and different things like this in a high inflationary environment where food and especially fuel is moving up. You've seen a massive spike in fuel in the last few weeks. So the markets are going to open up in about an hour and a half. Let's see how that affects us as we move forward. I don't know if anything's going to happen. There's a lot of stress out here, and as you can see, Bitcoin's around that 26,000 level. When it fell through the 27.5 support, that dropped us next level. We've seen this actually going down to about 24.8. 24,800, which is the low in this last drop. And so just keep an eye on this, keep an eye on the markets. There's a lot going on this week, and we need to keep up on all this information as we move forward and how that's affecting us. So God bless everybody. Find the open door, find Jesus. Turkey's getting ready to break out. The Middle East is getting ready to break out. Iran and Israel are getting ready to break out. But I'm looking at a potential uptick in the attacks from Turkey onto the Kurds, and potentially a move by Turkey as we move forward as a invasion into Syria and Iraq, which would lead you into your Daniel 8 and Ezekiel 38-39 prophecies. God bless. Have a great day, and find that open door. Find Jesus. Time is very short. Put oil in your lamp and get ready. This ride is going to get intense. God bless.